I began my investment journey at the age of 11. Before that, I had dabbled in various strategies without much direction, but my first real stock purchase ignited a passion for the market. Over the next 8 years, I experimented with timing, chart patterns, and a plethora of methods, most of which were fun yet ultimately unprofitable. My quest for knowledge led me to devour every investing book I could find at the public library. However, without a solid framework, my understanding was scattered. I relied on superficial indicators in hopes they would guide my investment decisions. In 1949, everything changed when I discovered Benjamin Graham's The Intelligent Investor. Before that moment, I had never encountered his work. The book contains only 2 pivotal chapters that fundamentally reshaped my investment philosophy. These principles are deceptively simple yet profoundly important. The first lesson is that a stock represents a portion of a business. It's crucial to view stocks not as mere ticker symbols but as investments in real businesses. Understanding a company's economic characteristics, its competition, and the quality of its management is essential for accurate valuation. The second key point in Graham's work involves the mythical figure of Mr. Market, which illustrates how investors should approach market fluctuations. Graham describes Mr. Market as a capricious partner who offers to buy or sell shares at varying prices every day, regardless of the actual value of the business. Many investors mistakenly allow their emotions to dictate their actions, feeling elated when stock prices rise and despondent when they fall. However, Graham emphasizes that the market exists to serve investors, not to dictate their decisions. The stock does not have feelings or knowledge of its ownership, it's merely a representation of a business's value. The third principle is the concept of a margin of safety. Just as one would approach a bridge with a weight limit cautiously, investors should avoid taking unnecessary risks. A solid investment requires a buffer against potential losses. By adhering to these foundational principles, one can construct a robust investment strategy. For sustained success in investing, particularly when managing significant capital, understanding the underlying business is paramount. Imagine being entrusted with $1 million and given a week to invest in 3 businesses in Tennessee. Your focus would be on identifying companies with enduring competitive advantages, those that can withstand market pressures and threats from competitors. A successful business needs to possess a moat that protects it from rivals, whether through patents, strategic location, or strong brand recognition. For example, Coca-Cola has built a formidable brand that resonates positively in consumers' minds, creating a significant barrier to entry for competitors like RC Cola. It's also crucial to have capable and honest management in place. Investing in a business that could thrive even under poor leadership is ideal. As Peter Lynch advised, seek companies so solid that even an incompetent manager could run them successfully. When evaluating potential investments, it's vital to filter out unsuitable options quickly. An efficient process allows investors to focus on a select few viable businesses. For instance, if tasked with identifying 10 stocks from the Dow Jones that would outperform the index, I would first eliminate those I perceive as weak or overly competitive, narrowing my focus on the most promising opportunities. With thousands of companies listed on the stock exchange, each accompanied by a daily valuation, investors have ample options. You don't need to be overly active in trading. In fact, having just a few good ideas throughout your lifetime can yield significant wealth. I often tell students that if they had only 20 inches punches in their investment lifetime, they would think more carefully about each decision. At Berkshire Hathaway, we prioritize larger investments that have the potential to move the needle. As our capital grows, the challenge of identifying impactful opportunities increases, but maintaining a disciplined and thoughtful approach remains the key to successful investing.